Good afternoon from Philadelphia. My name is Itai Goldstein. I'm the chair of the finance department here at Wharton and a co-director of the Wharton Initiative on Financial Policy and Regulation. And I'm happy to host this panel discussing the Silicon Valley Bank collapse and the aftermath. Maybe we are in the beginning of another financial crisis and an economic meltdown. Those are things that we will try to understand better today. It has been almost 3 weeks since the run on Silicon Valley Bank. For those of us who study financial crisis for a living, many things about this crisis looked very familiar. Some of them looked a little odd. Um, there were risks that were building up in Silicon Valley Bank. Interest rates have been rising and the bank has been exposed. And then what seemed to be overnight, depositors became worried and took their money out. And this was probably the fastest and biggest bank run in history, some of it due to the digital age that made things a little different. Nowadays that we are looking at it, everyone is asking, are we in the beginning of another 2008 episode? What exactly did the government do? What happened to financial regulation? What is going to happen with government intervention going forward? And what can we say about the interaction between the role of the Federal Reserve in monetary policy and in ensuring financial stability? Of course, there is also the real estate angle that is on everyone's mind. Real estate was an important aspect, a critical aspect in the 2008 crisis, and some of the tensions are building underneath the surface now as well, and we want to understand how this is going to interact with what we see in the financial system. So I have three perfect panelists that are going to help me dissect some of these issues and try to understand them better. We have Peter Conti-Brown from the Legal Studies Department. He is also my partner in WIFPER, the Wharton Initiative on Financial Policy and Regulation. We have Joao Gomes, who is my colleague here in the Finance Department, and then Susan Wachter from the Real Estate Department. I want to remind the audience that you can submit questions and I will be tracking them and hopefully turn to them later during the show. So let me start with you, Peter. You have been studying the history of bank runs and government intervention. So I want to understand from you to what extent you were surprised by what we have seen, the collapse itself, and then the government intervention that followed it.
I was not surprised by the fact of bank failure and collapse. In fact, just a few weeks ago, we were having a debate among financial regulation scholars and financial historians when the next bank failure would occur. We'd had a 32-month run, which is abnormal in financial history to go that long without any kind of bank failure. There were parts of the crisis that are peculiar to Silicon Valley Bank in some ways that made it a surprise how badly managed the bank was, how susceptible to what we might call a rational run as opposed to these irrational bank panics that tend to affect all banks, whatever their situation. My biggest surprise is that over the course of just 48 hours, the government declared the failure of Silicon Valley Bank a financial crisis as opposed to a period of intermediate bank stress. Our financial regulatory system is built to handle bank stress. This is why we have a variety of non-emergency facilities at the Federal Reserve, why the Federal Deposit Insurance Corporation has its suite of tools to go into a bank, even the very largest banks, over a weekend to understand how best to minimize disruption. We have these sets of tools so that short of a banking crisis, we can resolve concerns in a way that is both systemically appropriate, but also fair to all of a bank's stakeholders. And the government skipped nearly every single one of those. That shocked me. On Sunday afternoon, I predicted to some friends and on Twitter that we would see a good run of the intermediate stress tools I was completely wrong about that. Nobody should trade on my forecasting because I predicted that we would not see the invocation of the systemic risk exception that bailed out the uninsured depositors of Silicon Valley Bank, and predicted that we would not see the invocation of the Fed's 13.3 lending authority, which is what they used in 2008 and again in 2020. And so the questions we now have is, why do we have a full-blown banking crisis, as the government has declared, just 15 years after the 2008 crisis and 13 years after the passage of Dodd-Frank? Is it because we have such a fragile banking system that a single bank could impose that kind of systemic risk on us? Or is it that the financial regulators don't know how to use the intermediate stress tools that Congress has given them? I'm a little bit more inclined to the latter, but open to the former. Neither of these scenarios is good.
Thank you. And of course, one of the things that we have to think about going forward is the dual role of the Fed. And the Fed, on the one hand, is trying to stabilize prices and really fight this inflation that we see persistently over the last year or so. And then on the other hand, try to maintain financial stability. And I think that this conflict came into sharp focus with the events in Silicon Valley Bank and then the interest rate decision that followed after it. And going forward, we have to ask ourselves how far the Fed can continue to go. And I think, Joao, this is something that I would like to get your perspective on. What do you think happened? Where do you think the Fed is going from here?
Thank you, Itai, and hello, everyone. Unlike Peter, I was surprised, I have to say. Maybe I shouldn't have been, but I was. I was rereading Jay Powell's testimony before Congress just a week before, 2 days before, not even a week. And there's absolutely no mention of possible stress in the banking system, in the financial sector, as it processes this 4.5%, maybe 5% increase in interest rates in about 12 months. I have to say it was shocking to me to just process what was happening and the scale of what was happening in light of just what was Powell's assessment just a few days before. The Fed, we got into this year thinking that at least that was the paradigm the Fed outlined for us. As you said, there was a concern. Financial stability was not on the radar at all. And there was a real question whether we could control inflation down from 6 to maybe 2 without creating a recession. And I think coming into the year, the odds maybe were 50-50 that we would avoid a recession. And that's sort of the frame of reference. Bring inflation down. Can we avoid a recession? And now, since mid-March, suddenly financial stability starts to become a third rail in this discussion. That and it's just obvious to me, and it should have been obvious. It should have been obvious, I suppose, since the great financial crisis. And you and I have worked a lot in the last 15 years to try to get policymakers and to just consider and understand the impact of decisions in the financial sector. And now the financial sector is really important to transmit the impact of policies into the economy. And it's just obvious 15 years later that the Fed still doesn't have a handle on that. So that was shocking to me. And I think what started maybe now in the banking sector is almost surely not going to stay in the banking sector. How much contagion, how much spillover, that's an open question. I think for us, I think the things that I'm looking at right now is what's going to happen to lending standards, what's going to happen to credit for commercial industrial mortgages. And the housing market was already in trouble. Commercial real estate definitely in trouble. So I'll let Susan comment on that a little bit more. But the extent to which this will create and damage the economy and accelerate the path towards a recession in 23 now is an open question. And I think the Fed there was a sense that the Fed lost the plot when it comes to inflation. It lost the ability to control it, to even understand what was going on. And I think now there's a real question of whether should it even be a priority, given what's happening and what I don't think they understand about the financial sector, aside from any regulatory issues, which I think are major, as Peter said. But I think just how does this hike in interest rates gets transmitted into the financial sector and ultimately the economy, something that it's obviously puzzling them.
Yeah, and I would say, I think following 2008, we had this narrative that financial fragility moved from the banking sector to the non-bank sector. And I think the focus was on that, mutual funds and other non-bank institutions, and whether we can see a crisis coming from that and the extent to which they are exposed to the interest rate risk. So I think the surprise to some extent was the fact that it came back to the banking sector, and this is now the epicenter. And maybe this is something we can touch on a little bit more later. But I want to turn it over to Susan with a question on real estate, something that Joao mentioned. And as I said in the beginning, I think that real estate was clearly the focus in 2008. This is where the crisis started from. It's not the source of the crisis now, but clearly there are many fragilities that are building up in the real estate sector. And when we think about contagion to the rest of the economy, I think this is what many of us have in mind. So Susan, maybe you can tell us a bit more about that. What's going on with the real estate sector now, and to what extent is it exposed to these emerging risks?
Well, as Joao just said, what starts in the banking sector doesn't stay in the banking sector, and real estate is absolutely exposed, particularly commercial real estate. Even if we see no further dislocation, the tightening of the supervision and on the small, mid-sized regional, particularly regional banks, is, as we speak, slowing lending, and deal flows are for commercial real estate are on hold. 70% of the bank sector's real estate lending it comes out of the regional banks. And of course, it's the regional banks that are particularly under the supervisory crosshairs right now in response to this great surprise. So I do think that we have a significant problem in commercial real estate. And in fact, we had a problem prior to this crisis, obviously, with remote work in office buildings. Remote work in and of itself cut the value of office buildings, particularly in large markets in B, not A class buildings. But now we see vacancy across the board. If we have a recession on top of this, it's going to hit the valuation of commercial real estate really hard. With that said, what we now have is a commercial real estate crisis. And while the housing sector is in a recession of sorts, it's not the same thing as we saw in 2008, 2009, where households are impacted because they cannot refinance their loans because of credit risk. Now, they can't refinance easily right now because interest rates are high. That's a separate story, but obviously related one. The way out is, of course, what got us into this, which is high inflation, high interest rate. We need to see an easing of both of those. But if we do, then I don't see that this will move on to the household sector, and to the credit standing of the household sector, which would really take us potentially into a event that would be destabilizing.
So basically, you're saying that because this is centered mostly on commercial real estate and not residential real estate, the potential for damage to the rest of the economy is more limited, and hopefully we are not seeing another 2008.
This is correct.
Yeah. Joao, what's your view on that?
Well, I definitely agree that if that's the outlook, I think it's going to remain fairly contained. This feels to me, it certainly doesn't feel like 2008. I think we probably all agree on that. I'm not 100% sure, but I think so. But it does feel like 2006, maybe 2007. To me, there's vulnerabilities. There's plenty of vulnerabilities, and now we'll see what the developments are. I'm looking at consumer confidence. Does that hold up? There's no question. Housing prices have gone down. Mortgage rates are high. If we have, it all comes down to, I think, how intent is the Fed in curbing inflation? And I think there's serious divisions within the Fed about that, and they're still processing what was happening and how this is working. But back into your very first question to me is just how seriously should they consider financial stability? How seriously do they think is threatened? And what's the ultimate impact of that implied tightening? Because it's really what the increased regulation of banks and so on is going to imply. So is that going to be enough to slow down the economy and curb inflation? Are we really serious about curbing inflation, which is still at core inflation, maybe 5% or so, uncomfortably high and persistently high? Or are we going to just take a step back, let this play out, and let's see what the year turns out? And I think that's very much in the open. I don't think the Fed has made up their minds. I think the next meeting in May is going to be really important to clarify that. And we're also going to get data. But let's see where consumer confidence is. Let's see. Financial markets certainly seem to be comfortable right now, perhaps too comfortable with what was happening. So I'm inclined to agree with Susan on what is likely to happen, that we will just avoid a recession. But the price of that is, I think, inflation will stay higher for a longer period of time.
So, Peter, as a historian who watched the Fed very closely, what can you say about this moment that the Fed is in, and in particular the trade-off between the different objectives? The monetary policy on the one hand, the financial stability on the other hand. Do you think they're cutting the right balance here? Should they change the way they're doing it going forward?
I think that the Silicon Valley Bank weekend is an acknowledgement, in some ways implicit, in some ways explicit, that they are not cutting the right balance. I thought Powell's press conference after the most recent FOMC meeting was not great in terms of what it was not aware of ahead of time. Going back to João's point, that his testimony before the crisis in Congress was leaning so heavily on a 50 basis point increase on monetary policy without a word on financial stability concerns here. His answer in the press conference was, listen, we telegraphed this throughout 2022. It was in a lot of newspapers, and there was a little bit of chuckling there. But the Fed is responsible for bank supervision, not responsible for publishing its views in newspapers. So the Fed has to decide its appropriate monetary policy course, but even if it does so independent of financial stability concerns, which is a question open to debate, it then has to go through the process of verification. It reminds me of if you had a third grade teacher taking a group of 30 students on a field trip and came back with only 28 and said, listen, I told all of those students to line up at the bus and I got 28 of them back. We would call that a failure of a teacher. The central bank that has a systemically risky bank fail slowly then quickly because it didn't manage risk is not something you can simply blame on the bank itself. And that's because risk management in banking is shared across the public-private divide. So anytime you have a bank failure of this magnitude, the kind of thing that it imposes a systemic risk on our financial system, that's a failure both of the bank and of the Fed. So what should the Fed have done differently? What should it do differently? Its entire apparatus of verification is probably good. It's probably working well. The early press reports indicate that these questions of Silicon Valley Bank mismanagement were flagged early. What we have right now, and this accelerated in the last few years, is a system of verification, then trust. So we verify what's happening, and when you see issues, you flag them and then trust the banks to resolve them. And I think this is something that is, at least in the case of Silicon Valley Bank and probably others, something that we need to rethink. And that rethink would be to facilitate more rapid response in that intermediate stress period. The Fed knew that Silicon Valley Bank was not doing well. What it needs to have done in the days, weeks, even months before its failure is take more dramatic action, short of a declaration of a financial crisis, to get Silicon Valley Bank back onto a right path, or if they thought there was no path for it, to arrange for an acquisition or liquidation.
I mean, one of the tools that was developed after 2008 in order to address these issues is stress tests. Yet it doesn't seem like this was particularly effective here in terms of thinking about future scenarios and what will be the implications on banks. So do you think they should have done them differently?
You know, I feel torn about this. I saw a lot of discussion, participated in a lot of discussion about the very accounting issues that Silicon Valley Bank mismanaged in 2019 and 20. The last time this was relevant was in 2017 and 18 when the Fed was raising interest rates about 225 basis points over the course of several years. And so that issue was extremely well documented. Stress tests, though, are just one component of the supervisory apparatus. They were built in 2009 and then expanded after Dodd-Frank to model exogenous shocks to the economy, mostly to prevent financial crisis and fire sales and liquidations. And so they are anchored extremely heavily on a set of assumptions that the market will be in free fall. And when that's happening, central bank tools, the conventional ones, are to drop interest rates right away. So they did not model bank exposures to the opposite phenomenon, interest rates spiking quickly. They did a little bit, 200 basis points in 2015, but they dropped it because it creates an extremely mixed message. The capital strategy that you need to prepare for an exogenous shock to the bank is very different from the capital strategy that you need to prepare for in the other direction. And so I don't fault the Fed for using its major stress tests to look at those exogenous shocks. I fault the Fed for not using the plain vanilla supervisory tools that have been in existence for 50 years or longer to help these banks manage the asset side and the liability side of their balance sheet. And to be very fair, the overwhelming majority of banks, whether on their own initiative or with help from bank supervisors, did this beautifully. It's just a few that didn't that imposed this risk on the rest of the system. So I still don't know that we can have a stress test that can be ambidextrous in this way. We can do a series of them in different kinds of mechanisms, but the big, broad macroprudential tool that we developed after 2008 to test against big changes to capital availability and macroeconomic deterioration, I think stress tests do that well, and that this crisis just isn't that.
I see. So thinking about future scenarios and going back a little bit to how the Fed is going to deal with inflation. Susan, if I understood you correctly, inflation is very much at the heart of the problem also going forward, because if the Fed cannot control inflation and there will be this continuation of increasing interest rates in the future, then some of the problems are going to spill over to the residential housing sector and not stay just in the commercial real estate sector. So what's your view on that? How should they handle it?
Well, I do agree that with your summary of what has been said so far. And what's surprising to me is that the market, that financial markets are looking to the future of lower rates. And perhaps they're looking to recession as well, but that doesn't appear to be the consensus at this point. Rather, is it possible to have a recession, perhaps a slow growth, no growth? So there's a kind of a mismatch between what the Fed is at least publicly saying in terms of another 25 basis point rise, and in addition, this regulatory tightening. And I'm certainly would be interested in other, in particular, Peter, your views on this is equivalent to a 50 basis point increase. So with that, the Fed, to me, is signaling that they are insistent on a inflation decrease, that they're not going to allow inflation to persist, which means that we've got a battle ahead of us, because inflation expectations, at least for 4% inflation a year from now, which is double the inflation rate the Fed wishes, appear to be in place. So I don't see a way out without, even though I'm hopeful that if we have recessions, it's a soft landing. I don't see a way out without a slowing in growth to enable a significant easing in the economy to bring inflation down.
Well, that's a tough message. Hopefully there will be one. But of course, I understand the tension. And by the way, I want to remind the audience that you can submit your questions online. We have been getting some questions, and I'm following them, and I'm weaving them in as we go along. And with that in mind, while we are talking to Susan about the real estate implications, one thing that came up is still going back to the commercial real estate, which I think is on everyone's mind these days because of the aftermath of COVID, and as you mentioned before, the remote work. I think the idea was that, if it stays in the commercial sector, then maybe it will not be as severe a crisis and will not have such big implications to the real economy. But I think people would like to know maybe a little bit more on that. And, what is the potential for losses there, and how could it affect the banking sector?
Yes, well, we certainly already see a rise in delinquency, and some properties are being handed back. That there is default in the office sector. So, commercial is very large, obviously. It encompasses multifamily, retail, industrial, and the office sector. The office sector is absolutely at risk, particularly in large markets and Class B properties. And we do have a several $billion CMBS loan book that is coming due, and it's going to be on everyone's mind whether that is refinanceable. And that, of course, goes back to what happens to interest rates. If we can refinance these loans, then there will be a big sigh of relief. If not, we may see, the threatened office apocalypse absolutely could be upon us, which, we could lose valuation in particular markets and B buildings. They could be marked down 40%, without a surprise. All of that said, the implications of that is not an immediate this year crisis. First of all, these buildings are still leased up. If you look at their current vacancy, they're vacant 20%. That vacancy rate is going to rise over time, but it is going to be an over time outflow of ending of leases and outflow of office usage. So it isn't an immediate crisis, and as this decline in value in office space occurs, there will be responses, policy responses, and there already are, to use this opportunity to convert office buildings to housing. So it's not as though the entire book is going to decline, and certainly not rapidly decline. Therefore, the problems that we're going to see, they're going to be in pension funds, they're going to be in tax bases of cities. All of that's going to happen, and there will be losses, but it isn't a financial crisis, not an immediate financial crisis.
Thank you. Joao, as a macroeconomist, what are you watching when you think about real estate, how important it is for the question of whether we're going to have a recession, and then also this distinction between commercial and residential?
Mm-hmm. I think one statistic that I want to add to what Susan said is right now credit risk is outside a few pockets is relatively weathered this storm relatively well. There's not a sense that credit spreads have widened significantly. There's not a lot of nervousness, even in the high yield sectors. So I overall, provided the Fed does not surprise us with further interest rate hikes, I think we will be fine, relatively fine. How quickly interest rates come down maybe plays into that, whether it's over the next 6 months or a year. That's where the market and the Fed are significantly at odds. But I think we'll be fine. My thinking on this has always been that by a slim majority, I think the Fed would tolerate a recession to fight inflation, but I just don't think they'll tolerate financial chaos, a threat to financial stability. I think that's just too much of an unknown. As you all know, these kinds of financial crises just create very different macro dynamics, and it could all become a much more severe downturn than anything we've seen with a normal recession. At least I just don't think the Fed is willing to open that path. So I think they will be much more cautious about interest rate hikes, and this maybe another 25 basis points, but I don't think they'll go above that. I think the market is betting that the data on financial stability will be somewhat, or financial distress, I should say, should be somewhat more revealing in the coming months, and so various indices of financial distress that people look at will start to show concerns, and the Fed will eventually listen to that and will pause on interest rate hikes. And assuming that's true, I don't think commercial real estate is going to be, we will not see a significant impact there. I think by all accounts, return to work has more or less brought us back to occupancy levels that are close enough to pre-2020. So there are issues, pockets of issues, but I hate to say that I'm relaxed about it, given what I said at the beginning, but I feel like it's 2006, not 2008. I'm not especially concerned just yet, but I lost more confidence in the Fed's ability to understand what's going on and to process that in good decisions than I think I had coming into this.
If I may jump in, I agree with what Joelle said about return to work in many places. It's a big country. But in the large markets, return to work isn't going to happen in the office sector. The Eastern large, San Francisco, that are, particularly tech exposed, where there's been an acceptance. Friday's gone. It's just not happening, and Monday's in question. So my comments, while I am not seeing a credit risk, although there certainly is credit crunch, so I agree with Joe completely on that, are not pointing to the health of the office sector. I think the office sector needs total transformation because of the remote work. That was the hit of the COVID response. Now we have a separate hit coming from this financial crisis, and it has to transform in the middle of a 200 basis point interest rate increase. It's going to be very difficult, which means the transformation is going to happen over time. But transform it must, at least in many markets, not all markets. Some markets return to work is, as Joelle said, happening, but many it isn't.
Okay, let me go back a little more to the run and what we learned from it and what we can think going forward. And I want to go back to Peter. And there are questions coming in about the stress tests. So maybe you can come back to this a little bit, trying to understand why we couldn't design stress tests that will tell us, or at least warn us, of these upcoming risks. But I want to ask it maybe a little more broadly. Even if it's not stress tests, we should think about what kind of information mechanisms we have that would potentially warn us about those risks and maybe help us take a preemptive action before.
So let me clarify what I mean. I think that the banks were stress tested in the sense that one of the first questions that bank examiners would ask a bank like Silicon Valley Bank is, what is your asset risk management strategy? And another question near the top of their list is, what is your liability or funding strategy? And Silicon Valley Bank was overexposed on both sides. Take a bank like Citigroup that is very large, has a pretty diversified funding base. Its ratio of uninsured to insured depositors is 3-to-1. So about 75% of its depositors are uninsured. A bank like JP Chase, it's about 1-to-1, so about half and half. And Silicon Valley Bank was 22-to-1. Bank examiners above about 4-to-1 start to push back. 22-to-1. That was stress tested. The examiners looked at it and said, in the event of stress, these 22-to-1, that ratio, your 97% of uninsured depositors will run. Uninsured depositors are flighty. And so we had that information. What happens in stress tests before 2017 was that banks, the formal stress tests, there were two, is that there's a bottom line. The banks are told you are doing well or you're not doing well. If you're not doing well, then you're not doing well to this amount of equity that need to be raised in the markets. What the rest of bank supervision is designed to do is to do on countless permutations, have that dialogue. Are you managing this stress well? So there's no there. I just don't think the Fed was caught flat-footed at the level of risk management in observing these things. This is not 2008 for our listeners and even us on the call. I'm sure we were learning things in real time in 2007 and 2008 that required us to get smart about institutional details that we had never heard before. The big problem about 2008 is that the over-securitization of mortgage securities through various permutations, the use of derivatives, the exposure to counterparty risk, left us wondering who owes whom what, and what are the consequences of default here for the other side of the economy. That is not the 2023 banking scenario. Nobody has to ask those questions within minutes. You're looking through Banking 101 to understand how the assets and the liabilities are matching up. And so the thing that we need to do and need to understand is why didn't the Fed use the information that its supervisory processes generated? The fact that the stress test didn't model for interest rate increases is a red herring. They knew that there were problems here. They knew it. They documented it. Why didn't they act on that documentation? So it was not a problem of a failure of information. It was a failure to empower the right people to act on that information. And that's what we're waiting for the Fed and the FDIC and others to tell us exactly where the break in passing that information up the chain occurred. To have Jay Powell say, well, we thought the banks would read the newspaper is woefully insufficient.
Joao, Susan, do you have any views on the informational environment and maybe we could make it better?
Well, I actually have a question back to Peter that I'm puzzled about, which is I understand, and perhaps this understanding is wrong, that the bank had a model of risk that was known. And the model of risk was that if interest rates would fall and therefore that they should go long. And they were acting on that model of risk. Well, so the oversight supervision knew they had that model of risk. Why didn't they substitute a better model?
So the model you're talking about was what there were 2 points in which the Silicon Valley Bank invoked this model. The first one was pretty defensible, and that was in Q1 and 2 2020. This is at the height of the early stages of the pandemic. Everything had crashed, and so they put half of their assets into these 150 basis point mortgage securities, and they were just making free money. I mean, it was the easiest thing because they were seeing a simultaneous explosion in depositors come in demanding 0%, using the bank as a warehouse, and then getting 1.5% on their assets. So their model that they could go long here was pretty defensible. It was a model that was shared across the banking system. They did it again at the end of 2021. This is when almost all other banks did the opposite. Here we are getting, this is, if you'll remember, this is where the Fed is starting to eat a healthy helping of humble pie about the so-called transitory inflation debate. It is right before the Fed starts to dramatically signal that they were wrong and that they're going to start moving aggressively. And there, the model was, well, we're making so much money, we're gonna bet against the Fed, so to speak. We're gonna bet that this is going to be resolved relatively quickly. That was an egregious bet, but it was a bet, and if they had won, they would have made an awful lot of money. The problem is what happens in Q1 2022, and then every day thereafter. That is when they realized their bet was wrong. That the inflation was entering a kind of escape velocity, and that the Fed was going to follow it. And they did nothing. And the Fed knew about all of this. And so it's the same question I'm asking, Susan, that you're asking, which is, They knew that this model risk at Silicon Valley Bank was erroneous. So why didn't they do more to shore it up? And that's where we just still don't have the answers.
Joao, what do you think about the informational environment?
I think so I broadly agree. I'm just going to make two different points. I know one place where I don't agree with Peter, I think is important, is the lack of deposit insurance here. I think this, but I would agree with the broad point that this is so simple. There was nothing spectacularly difficult to figure out. It was so simple that the main difficulty for us was to understand it was really simple. And that's sort of what threw you off. Like, could it be that obvious that this was a problem? But I think the lack of deposit insurance, that lack of understanding that actually matters, we just took that for granted. I think from a policy standpoint, I think you just assume, of course, nobody's going to run. Why would they run our banks? This is sort of a 1930s thing, maybe 1980s thing, but it's over. We just don't think that matters anymore because it's sort of implicit there anyway. Why would anybody worry about it? And if you think that's true, then you can sort of also accept that these losses are paper losses. If you hold them to maturity, it's not going to matter at all. And I think that was a simplification in thinking that, or a corner that we cut in processing the impact of this interest rate hike, that I think policymakers forgot about it or just didn't include in their thinking. But I will make a second point, which I've made for a while, which is you cannot hold the Fed entirely blamelessly or even partially blameless. I think this is what happens when you introduce massive dislocations in financial markets, which we've done since 2008, and then again dramatically in 2020. Massive dislocations in deposits, massive dislocations in credit markets. And if you do that, unwinding those kinds of situations is going to be complex. It's just going to require a lot of attention, a lot of care, that you didn't put stress or you didn't remove stress in one place and not another. This was the place where we saw the manifestation, but it could have been different places. And I think it was incumbent on the Fed to be extra watchful for what was it still is a historically, I think, I won't say unprecedented, but certainly unprecedented 50 years, increasing interest rates of 5% when you put so much leverage in various places in the financial system. So I do think we should hold the Fed much more accountable for putting us in this position in the first place in the last 15, but certainly the last 3 years.
Can I just respond quickly to Joao's points? I think they're great. I agree that the Fed cannot skirt responsibility for the fact of such aggressive and unusual rate hikes. The mechanism for that verification is bank supervision. So if the Fed finds itself constrained, whether by its own actions, the fiscal policy climate, the geopolitical climate, whatever it might be, that the Fed says we have to act drastically, then the mechanism, the metaphor that they love to use over and over again, is to foam the runway. You don't do that by the so-called open mouth operations or jawboning or moral suasion. You do that with bank supervisors walking into every single supervised bank and verifying that they are managing the risks that the Fed itself is imposing. And so I think it is both a failure of the fact that the Fed found itself in the position to raise interest rates 475 basis points in 12 months, but also the failure to make sure that their own policies were being followed. Now, Joao, your point that we just took deposit insurance for granted, I think that is probably true for central bankers. It is not true for bank supervisors. They, in every single bank examination in America, they look at that ratio of uninsured to insured deposits. And the fact that Silicon Valley Bank was so out of whack, the fact that we had major corporations whose cash management practice was to put $500 million in a single account at Silicon Valley, or $3 billion in a single account, is something that bank supervisors watched. They warned, and they said, it doesn't matter what kinds of contracts you gave to them to tie your deposits to your loans. Uninsured depositors are flighty, and you need to take these steps. So the bank supervisors, we are nearly certain, we haven't read what the matters requiring attention, these reports that bank supervisors wrote. We haven't read them yet. They are not public. But I'd bet my eye teeth that they include warnings about those very issues. They're just not issues that everybody up the chain was tracking in the same way.
If I just may make one quick point to rejoin to that. this is a good, taking us back to the very first question you asked, there was then no connection between what the bank supervisors were seeing and watching and what monetary policy was actually doing. This was just not part of the calculation of the impact of monetary policy at the Fed for better part of 12 months. And I think that's, again, a failure of policy.
Itai, may I ask a question?
Yes.
There's also another question that's puzzling me. So the savings and loan crisis was all about the asset liability mismatch of holding long-term mortgages when the liability is short-term deposits. Very reminiscent of what we're doing, what we're seeing here. History does rhyme. So you would think that one of the first questions that would come up when it was Fed puts out its new policy of fighting inflation by raising rates dramatically 400 plus points is who's holding long-term mortgage-backed securities, and should we not look at their vulnerability? And we do have actually a Financial Stability Oversight Council, the FSOC. So I'd love to have folks, everyone, perhaps, Itai, maybe you also. Is this a failure there as well?
I would think so, yes. I mean, I think in general, and I connect here to what Peter and Joao said before, I think there was this general notion that there is a trade-off between price stability and financial stability. And I think that there was a lot of discussion of what areas of the financial system are going to see the fragility as a result of tightening monetary policy. But what we see in hindsight is that they were not looking necessarily at the right place. And maybe they were not looking at the most traditional place that we should have known from textbook. And I think this is what is so surprising about that. And here I connect to what Joao said in the beginning. So I would say, in my opinion, that there is quite a bit here to learn going forward for how to manage financial stability and how it interacts with monetary policy. Going back maybe to one issue, and here I will ask a follow-up question. I think one thing that we saw very clearly is the importance of the base of depositors and the idea that when depositors are uninsured to a large extent, we need to watch them very, very closely. And I think they were aware of it, but maybe not enough, and maybe there wasn't enough focus on this. I think the other point here that is important is just the concentration of the depositor base, the fact that they were all coming from the same industry, and then also highly visible and connected to each other. And those questions are coming up here from the audience. What is the role of social media? What is the role of the communication and the conversations among the different depositors? I don't know if anyone wants to comment on this.
Yeah, I could take a stab. Stephen Kelly, at Yale, made the point that I thought was very good, that this was a run, but not a run on the bank. It was a run on the bank's business model. And the business model here, lacking diversification, is breathtaking. Silicon Valley Bank viewed diversification if we're funding one startup that has an app in cryptocurrency and another that has an app on the blockchain, then that's diversification. But of course, that's not how banks normally think about diversification. That's certainly not how the Fed does. And I think that lack of diversification exposes them to idiosyncratic risk that only becomes systemic if the government either decides it's systemic or because of the size. What we didn't have is the problem of systemic risk and counterparty risk, where there was just a vastness, a web of connections. The ecosystem for Silicon Valley Bank, its footprint was very small. I think social networks mattered enormously. I've seen no evidence that social media mattered. By the time people were gasping about things late Thursday and Friday on Twitter and Facebook and Instagram, all of the people who had been spooked by Silicon Valley Bank's mismanagement had already issued their withdrawals. I spoke to one of them who was working the phones on Wednesday And I asked him, like, what do you mean by working the phones? And he was literally, it was a phone with an old wire connection between handset and base. So it was very technology circa 1950, and he was just calling people in that network. And so the concentration of the social network mattered enormously. But I think the evidence that somebody can start a whispering campaign on Twitter and all of a sudden a healthy bank is dead, that was not what happened in Silicon Valley Bank.
I'm torn a little bit. I think on the one hand, I mean, I think every run is a run on the bank business model. You just don't think the asset base is going to be there to cover your deposit, and there's a reason for that. I think that what makes it systemic, as Peter said, is the government maybe decides that it is systemic, the web of connections, but also contagion. And I think that's where the social media aspect might give us some pause. In the abstract, information is good. And you're an information person, Itai, I know. So, the faster to disseminate information about what's happening in the economy, I think, generally speaking, the better. But it also introduces challenges for policymakers. And it creates contagion where potentially none existed before. It spreads panic to maybe different institutions that have nothing to in common otherwise. So it gives me a little bit of pause. I think one point that I've thought about, and I'm not my expertise in banking is not comparable to all of yours, but it is how you think about the risk weight of government bonds when you think about capital adequacy ratios, which I always thought that it was artificially low for reasons that may have to do with wanting to subsidize government debt in some ways, political reasons, not economic reasons. And I think this introduces that question of maybe this risk weights and how you think about the right capital adequacy ratios as a function of assets should be reconsidered for all these reasons that we discussed before, but also I think for this particular one, that this crisis was not induced by expected defaults or expect losses on your loan, on your commercial industrial loans or your mortgage. It was in the asset that we thought was second to cash in terms of safety.
So we have only a few minutes left, and perhaps not surprisingly, questions are flowing in on the economic outlook going forward. And I know that we touched on that, but people want to know a little more where we are going from here. So one thing that Joao mentioned, and I think maybe you set yourself a trap there, Joao, so you will have to address that. You kept saying that this is not 2008, but 2006. So the obvious follow-up question is, are we expecting 2008 to come in 2025? So that's something I would like to hear from you. But then maybe you can broaden the scope a little more and talk about the global outlook, because some of the audience is international, and people wanna know what are the implications, what are the spillovers to the rest of the world.
Yeah, my best guess is this is like 1998 LTCM kind of flash in the pan event, and nothing happens after that. We've had lots of those, but I always think big crises are an accumulation of small events that eventually just pushes over the edge. It's not one big event that happens in the abstract. So I think this is one in that sequence in an economy that was already had its vulnerabilities. But I'm not forecasting anything particular for 2025 now. Internationally, Europe faces some of the same challenges. Of course, what's happening with the Swiss banks is very different. I can't claim that I understand Deutsche Bank at all. Peter, probably you do, but so it's hard for me to draw too much of. I just don't think I have enough data to feel very comfortable about what's happening in Europe at this point. I don't think there's anything that's changed my outlook relative to the beginning of the year. I think it is a difficult year, but I think their inflation is coming down very quickly, and hopefully that economy was never sort of set up to grow very quickly, but it's going to weather whatever is happening much relatively smoothly. But honestly, I have to wait and see and get more data.
So thinking about international, and Peter, maybe I'll turn it to you. Joao asked about Deutsche Bank. Of course, there is Credit Suisse. So we managed to go for 55 minutes or so without talking about Credit Suisse. and I think we need to maybe say something. So how do you see that?
Credit Suisse is a really important case for us to think about. It's the first failure since the creation of the GSIB category, these global systemically important banks, of a GSIB failure. What is so fascinating about it is the idea that, you know, in banking, bank failures look an awful lot alike in some respects, but I've almost never seen two that fail identically. And I can't remember two large bank failures that ever that looked so differently from each other than Credit Suisse and Silicon Valley Bank. Credit Suisse is the opposite of Silicon Valley Bank. It is an absolute global powerhouse. It had extremely valuable assets. Its wealth management division was one of the best in the world, and it failed largely because it was mismanaged on nearly every one of the key parameters that bank examiners and supervisors look at, whether we're talking about its capital or liquidity, its ethics, its management, its counterparty risk, its capital strategy, its equity partners. They were so overexposed on nearly every dimension. And here's something that we can say, everybody knew this. So there's no surprise with Credit Suisse's challenges. It's been an international banking basket case of long renown. What is so interesting is the way that the Swiss, quote unquote, resolved it, which is by skipping every aspect of resolution. Probably the most important policy decision that has come out of the 2008 financial crisis was the idea that may now be a conceit that we can safely resolve, unwind a GSIB. And the Swiss finance minister said, that's a canard. It's not possible. You're going to have to bail them out in some way or another. You're going to have to pass new laws. You're going to have to shake up priority and reward equity before you reward unsecured creditors, which is the opposite of how things are supposed to work. And so it puts real pressure on the idea that these GSIBs can fail at all. Credit Suisse couldn't, at least by the Swiss political assessment. And it's important for us to reflect on that for all of the other GSIBs. We have an awful lot here in the United States as well.
So Susan, in the last minute, do you see different real estate issues around the world than in the US?
Well, we're not now in the real estate predicament and vulnerability that we were across the globe, at least in Europe and the US, where we had overpriced real estate. We had bubbles that were building from 2004 through 2007. That's the good news. But real estate is, of course, vulnerable to interest rate increases, and interest rate increases can cause credit risk. So I am not as optimistic, as hopeful as perhaps Joelle is about this being a one-off 1998 kind of situation. It seems to me that the inverted yield curve situation is a risk to banks. The longer it lasts, the worse it is. And this is a matter of how sticky is inflation. It's certainly not transitory. We know that very well now. How sticky is it, and how soon can we get that inflation rate down and out of a bigger potential crisis mode?
Okay, so with this slightly more pessimistic note, I think we will conclude. We came to the top of the hour, and I think we learned a lot about what happened in SVB. What are the risks in the financial system? What are the implications?
Thank you everyone for joining us. It was a pleasure to be here, and I hope this was instructive to you. And I'll hope to see you for the next edition whenever we have another crisis, which hopefully is not going to be for a while. Thank you, everyone. Thank you, Susan. Thank you, Peter.
Thank you.
Bye now.